Hey, Jessica, it's good to see your face.
Sorry, I'm trying to figure out Zoom on my phone. I'm struggling.
No, you're totally fine. To be honest, every time I have to present, I have to relearn how to work like the presenter side of things. And I'm just now realizing I can make it so I can actually see everyone's faces while I'm talking, or instead of like this tiny strip. So now I'm excited about the whole thing.
Nice. Good to see you.
Good to see you. All right. Well, I want to be respectful of everyone's time who hopped on right up to now. And so I'm going to get started. That way you guys aren't stuck waiting to have dinner. And if you're as cool as Andy and Libby are, feel free to start happy hour. I will be envious of you guys as I am not getting to have a brewski tonight. But I'm excited that you guys are here and we're talking about wealth today. This is something I'm very passionate about, and with all kinds of stuff that's been in the on the interwebs the last few days about the rental market in Arizona. I think this is a particularly interesting time to be having this conversation. So I encourage everybody in the chat box to go ahead and throw in the reason you came today. There's something you're hoping to learn about, or maybe a specific question you have. My goal will be to cover everything as we maneuver through this presentation today. And so while you are dropping those ideas in, I will start by not everybody I know super well on this call, or of the people who will also be joining us. So I want to educate you a little bit. I'm a real estate agent here in Arizona. But what I have done with that has been really to focus then on investing, which is a strong passion of mine. And if you don't know my origin story, it came out of homelessness. I was homeless as a kid, and once we got out of that, I had kind of just a different appreciation and perspective on it. And so it was always really important to me to be able to create generational wealth through real estate, even though I had no idea what that looked like. And as I got ingrained in real estate, I started to realize how easy it is. And I recognize, for anyone on this call who doesn't already have an investment property, that sounds like a weird thing to say, like it's easy. And it is. That's the crazy thing. And I think the myth about investing in real estate is that it either takes a lot of money or time or whatever. And some of those pieces can be true, but not all of them are. And it's certainly doable for literally anyone, which is why this class is invented. It kind of gives you an idea on some things I'm invested in. My primary portfolio is residential resale real estate. So 6 single family residences, 1 duplex, and 1, I call it a short-term rental for legal purposes, but it's also mostly just a second house. I don't actually advocate for short-term rentals. That isn't something you're going to hear a ton of from me. I could explain if anyone's interested in what that is, but short-term rentals are not my jam. But I'm also an investor in a couple other things: a Keller Williams office, an apartment complex, 3 different mobile home parks, now oil and gas, which is new to me. My kids are home now. That's great. That'll add an extra flair to see who pops in on the screen. TBD on who runs in first. And then I'm also an investor in a title company, which is an ancillary service for real estate. So all of this to say, I love investing. I love analyzing things. I love figuring out if something's a deal or not. Like, this is something I'm passionate about. So if you don't know, now you do. So we're going to talk about why to invest in real estate. Obviously, y'all have some sort of interest in it. Otherwise, you wouldn't have shown up today. But a lot of people primarily focus on 2 main reasons for investing in real estate and forget or don't know about the other 2. So the primary things that we see pop up are, number 1, cash flow. I want to have an investment property, so I'm making something passively without having to do any real work. That makes sense. And then number 2 is usually appreciation, right? Buy something now, in the future it is worth more. You made money because of a good decision you had 5, 10, 15, 20 years ago. The 2 things people don't think as much about are happening on the back end. So it's easy to not pay as much attention to that. The first is the fact that, and as I'm rereading this, principal reduction is not what I mean to say there. It's really your loan balance is being reduced, right? Your tenant is paying for this investment for you. right? Let's equate that to, let's say you wanted to buy $100,000 worth of Apple stock. Apple would then say like, perfect, I need $100,000. And then let's say you're like, my friend Corey is going to give you $100,000 on some sort of regular schedule for me on my behalf. And then at the end of this, I will later sell that $100,000 of stock for whatever multiplier it is. That's owning real estate. And it's something that I just want to make sure is such a strong point, because it's kind of the unsung hero there. And the fourth opportunity being tax benefits. If you don't know, when you have a rental property, it's essentially a business, right? So just like a business owner is going to have tax write-offs, your investment property is going to be subject to tax benefits. I could get into a very long monologue about my feelings with paying taxes in general, but it is negative. I don't want to pay any taxes. And so real estate is a great avenue and vehicle to accomplish what the government wants, which is to create affordable housing for other people, through something that's also going to benefit me. Tax benefits might look like improvements you make to the property. It could look like what's called a cost segregation analysis, which is essentially expedited depreciation on the property. So for my homeowners on this call, which I think is almost everybody, you might know either through filing your own taxes or having an accountant file them for you, that you get to depreciate the property, which is always interesting to me, right? The house is increasing in value, but somehow you're getting to write off the depreciation. I don't know. I'm too blonde to understand this concept, and I don't care. All I care is that I get money in exchange for already having something that's still making me money. But when you have a rental property, that cost segregation analysis can enhance that depreciation. For this call and where most people are in their investing, I'm not going to dig into that. But for any of my more seasoned investors on here, please ping me and let's kind of circle back later on how to take advantage on a cost seg with investment properties you currently own. If you don't have a current investment property, this is not something for you to worry about right now, but a future thing to know about. So before I dig into the real meat of what we're going to talk about today, are there any questions on the 4 main reasons someone would invest in real estate? You can unmute yourself, you can drop comments down, you can do whatever. In the meantime, what I'm doing right now is I'm pulling up a link to share with everyone, so you have access to a, so what we're really going to be talking about today, which is how to analyze properties. So if I look at some of these questions that you guys put in today and what we asked in that Google form, the main question I had was, is there anything you want to know or want us to know about your situation? And a general overview I got was like, how do you even know if an investment property is a good one? So we're going to talk about that. That's the link that I just dropped into this chat. When you go in there, and you're welcome to either play with it now or later, you're going to start by making a copy. So file, make a copy, because this is something that I share with everybody and their brother, and you don't want them coming behind you and editing all your stuff for you. But after you've downloaded it, whether it be now or in a minute, come back and I'm gonna walk through this together. So let me switch screens real quick. Let's do this first. So this is what we're covering today. We're going to talk about what you're looking for, getting your finances aligned, identifying your dream team, and writing offers on great properties. So let's start before, I got cart before the horse. Let's start with how to understand what you're looking for. Now, if you've listened to Bigger Pockets or any other sort of investing thing, you might at some point in time have heard of something called a buy box. A buy box is the general criteria that you would consider when looking at an investment property. Now, I want to take a step back and explain 2 different theologies of investing in residential real estate: single family houses and multifamily housing. Now, for this conversation, I'm going to keep us in the land of residential real estate, which means 4 units or less, so like a duplex, a triplex, or a quadplex, versus a standalone house, townhouse, condo, something like that. With our single family houses, townhouse, condos, that stuff, the benefit to them is they're going to appreciate at a faster rate than multifamily. So more appreciation. Your long haul is here. But the inherent con with single family is if there's one door, there's one rent. So if that person does not live there anymore, you do not make money off of that door, right? So that one door is either money or no money. Pro to multifamily and whatever aspect of that is the opposite. If you have one door over here, you have two doors over here. And the odds are that both of your doors aren't empty at the same time. So it can help offset some of the costs. And when they're all occupied, it would give you greater cash flow. But the downside to multifamily is that it typically appreciates at a much slower rate compared to a single family house. So the way I like to look at it is you've got cash flow or appreciation, pick. But you really do want to pick, because sometimes I'll have people say like, yeah, whatever. It's really hard to switch back and forth between analyzing a single family house and a multifamily house. Now, I have a couple of people on this call who have an investment property. So you might be at that point now where you're like, okay, well, I'm ready to pivot from single family to multifamily, or I feel confident in my ability to look at the two. But for the most part, I would say it's tough. And so I would pick one that you're interested in more than the other. So now let's take those two examples. Let's say you had $500,000 to spend on either. The buy boxes for those two will look different. So I gave some examples here. If you were in the single family house camp, here is an example of what you might be looking for. For me, and an investment strategy that I suggest to others, it's to go as vanilla as you can with what other people would want to live in, because it's easier to rent, right? If you have a 10th story Camelback Esplanade condo that you're renting on the luxury market, a few people might be able to rent it versus everybody and their brother who's interested in a 3-bedroom, 2-bath in Phoenix, right? So I like to be very average, and that's my style of investing. But again, your house, your buy box. So that, a couple other things to think through. Pools cost money. You make more in rent, but in my opinion, the offset of them is not worth the maintenance expense and liability. So I don't personally go after homes with pools. I do have one that has a pool, but that is something that I look at. And then you would want to have a geography, a place you want to look. So if someone was looking at Arizona real estate and they said like, yeah, anywhere in the greater Phoenix metro, but they didn't really know where, we would want to talk about like, how can we fit a price point, right? We want to get narrow on geography, because for my friends who live here, we can't compare a house in Gilbert to a house in, let me use a better example, a house in Phoenix to a house in like Waddell. They're not the same. Most of you probably don't even know where Waddell is. And so the point is not the same. So we can't just greater Phoenix metro the whole thing. We need to be a little bit specific. As an example, for me, I like the Glendale Peoria border, because the price point is a happy medium for me of homes I can acquire relatively easy as far as the down payment is concerned, aka the price point is lower. But I also like the rental amount on them. And that's really what we're going to talk about when we look at the spreadsheet. Is the only thing that matters when you're looking at rental properties is your return. I get a lot of people who will say something like, I want to be in a Class B area. That's a specific set of verbiage to use that does not apply to residential real estate. It might come up in like a Bigger Pockets podcast, but it's really more of a large scale multifamily kind of saying to use. What they mean is like, I want to be around good schools or good shopping or whatever they consider to be a good neighborhood. Good neighborhoods cost more money. So like anything, right, you might get a higher rent, but you're also going to get a higher purchase price. What you want to do is make sure that those two rise and fall in the direction that makes sense to still invest. If you bought $1 million house, but lost money every single month, it's a step back. If you bought a $300,000 house, but you made $500 a month, that's a solid investment, right? So it's not just about where the house is, it's about the environment and what those numbers support. Let's take that same $500,000 price point. Let's look at multifamily. you were looking at $500,000 multifamily in Phoenix, what you'll probably find is those units on average are going to be a much smaller rent per door. If you're getting $2,000 a month for your single family house, maybe you're getting $1,200 a door over here. It's still a higher net, but it's just to say that means the type of person who's going to rent that property is looking for a more lower end rental, and that's what they can afford, which is fine, but it just means it's different, right? It changes our numbers. So you just have to be aware of that. Maybe we're looking for something that's a rehab opportunity, right? Putting sweat equity into multifamily is going to be a much better position than purchasing a house that's or a complex that's ready to go multifamily. It's been a lot of flipping in the duplex, triplex, quadplex space, and it's making for terrible purchases. I've seen a lot of people buying like really nice triplexes that don't cash flow for anything because they just paid way too much money for them. And then you might have criteria that you want both units to be 2 bedrooms or whatever the case is. All of that verbal vomit to say, this is what your search then gets built off. So if Libby is looking for a 3-bedroom, 2-bath house, that's what's showing up on her search. She's not also looking at 5 bedrooms and 1 bedrooms and condos and houses in Gilbert, because you'll never be able to analyze them properly. So it's okay to be specific. I think a lot of people get wide because they're worried they won't find anything. You're going to find something way better getting specific than going wide and just taking a shot in the dark. I say all that because what we're talking about today is buying investment properties, but I want to make sure I'm not shortchanging this conversation by saying the best way to become an investor is to convert your primary residence into a rental property. Couple of things you would want to keep in mind. When you purchase a primary residence, your interest rate is lower than an investment property. If you live in it, it's a lower rate than if you invest in it. Your down payment is also different. You can put 3.5%, 5% down over here, or 25% down over here. So you have a higher interest rate and a higher down payment means it's a lot harder to buy an investment property because you either need to be sitting on a ton of cash, which you are, it's a great opportunity, but your cash on cash return is going to be way better if it used to be a primary residence because you're not paying as much in interest. So if you own a single family house that is not your forever home, that's where I would start, is saying like, is this something that I could rent out? And we'll talk about how to analyze it. That's what we're doing here today. But so the answer to that question lies in the analyzing of it. But unless someone is in their forever house, I would always start by considering just purchasing a new house. I could probably even give a quick example on that. Let's say you're in a house that's worth $500,000. You have to write it down so I don't screw up these numbers. And you bought it for 10% down. You spent $50,000. And let's say you wanted to buy a $500,000 investment property. That's 20. You would need $125,000 in that case. So you need $75,000 more just to buy the house. And then you're going to pay an extra 1.5% on the interest rate to be able to get that loan in the first place, right? So you can see very quickly how those numbers would be difficult to achieve in both cases. But let's say you're in a $500,000 house now and you wanted to move up into $750,000. If you put the same 10% down on your new $750,000, that's $75,000. Right? So we've saved $50,000 because we didn't go buy an investment property. We just bought a new house and we converted our same $500,000 property into a rental. So the cash out of pocket is easier to do a step up or even a lateral move or even a downgrade, right? Maybe you're in a big house now and you want to move into a smaller townhouse or something like that, but it is always going to be a more affordable decision to go that way. But this whole conversation is going to be about if you didn't do that, because everything we're going to teach will apply to that same concept. But I want to stay focused on if you're looking at analyzing an investment property. Questions on this before we move into financing? All right. So with that being said, depending on the route that you're going would depend on where your money's coming from. Now, if you're going to be purchasing in either case, if you're purchasing an investment property or you're going to just be converting your current property, you might choose to take out a HELOC against the current home you have. So for, I don't know if I have any renters on here right now. I don't think so. If I do, maybe let me know. So I'm going to pretend we don't have any renters. So with your current house, you likely have an obscene amount of equity in the property right now, which is cool, right? You made a smart decision, also got very lucky with the market, and now you have money in this house. That feels cool. It's always a cool thing to talk about. It's nice to see it on a net worth tracker or however you're managing your finances. But at the end of the day, the only way you get that money is if you take it out or if you sell it. Now, we're not talking about selling in this example, although I know someone who can help with that. What we're talking about, though, is using that equity to your benefit. So a HELOC, home equity line of credit, is something that you can do to essentially tap into the equity in your house as a loan to yourself. It's the equity on your house that you're paying back to the bank. Now, the reason it's so popular right now is because refis are so unpopular. I'm guessing the majority of you have interest rates somewhere around like 3%. And so refinancing that house into, I think rates today are at 7.6%, refinancing into a 7.6% loan, less sexy. It's part of why we have such an inventory crisis right now, is because we have sellers who shouldn't sell those houses. They should keep them. If you don't have to sell them, you shouldn't. You should keep it. So we take out a HELOC because your higher interest rate is only going to be on that chunk of money. It's not on the whole loan of the house. It's just on the $50,000, $100,000, $150,000 you're taking out. That's how we can get creative with our cash. There's also like the way you bought your first house saving. So depending on what your goal is, saving in whatever capacity, if you want to buy a rental 2 years from now, you can take that estimated down payment, divide it by however many months you want to get there, and that's your monthly saving goal. Another creative solution would be tapping into 401ks or other investment forms where you're like, I have an account, but I'd rather have control over it, and I want to put that into real estate in whatever capacity. You'll pay fees, but you'll work with your lender to understand, does the cost of this make sense compared to waiting 5 years and paying a higher purchase price for the house? So there's a lot of things involved, but the short version is, if somebody wanted to invest in real estate, they're going to start this conversation with an agent or a lender. There's no step one, step two. They can really be interchanged, but they're going to be able to give you insight on maybe some creative solutions based off of your specific situation. I also put here, and you'll see in that black box, your net worth is directly aligned with your net worth. Said differently, you also either have friends or could make friends with rich people who want to employ their money for use, right? Let's say Jessica wanted to buy an investment property, and let's say Libby had a bunch of cash that she is just sitting on and she doesn't want to be a landlord or whatever the case is. Jessica could take a loan out from Libby to then use as her down payment or financing for this property. So there's creative ways that, based off of your network, you might have solutions right in front of you, but you're just not having those conversations with people. How you get into those is a whole separate conversation, right? Like approaching your Uncle Bill at Thanksgiving and being like, you seem rich, you want to work with me on a house? It's a whole separate conversation. But once you identify if there's people in your world, then that's something that you could work through as well. Questions on financing? Okay. Let's take a step back. Where is this in here? Okay, so I'm going to switch screens and we're going to look at this spreadsheet together and run a sample property. In the world of investing in real estate, the only thing that you need, not the only thing, the most important tool you will use is this spreadsheet. When you're buying a house you want to live in, you go see it. Right? You walk in, you smell it, you drive the neighborhood, you maybe don't like the layout of how the kitchen flows with the living room, right? Those are the things that we can appreciate when we live there. When we're not purchasing it up as a primary residence, the first thing you should care about is what the finances tell you in relation to your goals. So before I dig into it, I'll give an example. When I converted my first house into a rental, when we bought our second house, I said, I just want to make $100 a month. I'm not looking to get rich off this property. I just want to make $100 a month. And that property is now my cash cow. I always joke that like that thing is not going anywhere. I love this house. It makes me a ton of money. But not $100 a month anymore. But it started with that. So I got my taste of the good stuff, making $100 a month. And then as I learned more about investing, I learned that I could do better than $100 a month. I could do $400 a month or $600 a month. Those are very difficult to come by, but I knew I could if I tried hard enough to find the right property. And so that's to say you only learn by actually learning and doing. And I learned the hard way. So I'm going to teach you guys how to learn up front so you can make good decisions on your investment property instead of like lucking into it and hoping it works out. So I'm going to use the example of said cash cow to give you guys some examples on how to analyze a property that you're purchasing. And then I'm going to teach you how to analyze the property you might already own. So the yellow cells are the cells you're most likely to edit regularly, and the white cells you are likely to only edit once. You edit them once because you're going to edit it to your preference, your investment style, and what's important to you. So let's use this example. My first house, let's say it's worth $425, that's fair market value, and it's listed at $425. So those numbers are the same. The first thing you might have a preference on is if you insist on buying a house for a discount. Now, that's not always possible, right? In today's market, that's more difficult to do unless a house is market worn. But some people won't buy a house unless it's 80 cents on the dollar, 70 cents on the dollar, 60 cents on the dollar. I myself just don't want to overpay, and it's a bonus to me if I have extra equity. So I would put this at 0%, but you might choose 5% or 10% off or whatever the case is. So this box right here tells me what I can offer. This takes the heart part out of writing an offer. When you're writing an offer to live in this house, it's real easy to be like, I don't want to lose this over $5,000. Like, I'm going to live in it for 20 years or whatever your plan is. I'm not losing it over $5,000. But in this world, it is a numbers game. Because the only thing we look at are the numbers. So this tells you out of the gate, your max offer can be $425. So it helps in a multiple offer situation to be like, sorry, that's my highest I can go. Percent down. For buying an investment property, the number is 25%. You can get really crappy loans less than that, but you don't want them, so we're going to go with 25%. So this tells me if I want to buy this house, I need to have 106 liquid, and that my loan is going to be for 318. I don't know if this interest rate is doable right now. And why I say that with like a sad face and a sad voice, that doesn't mean it's a bad time to invest. It's easy for people to say like, well, I don't want a bad interest rate because of fill in the blank. But the common thing I'm telling buyers right now is a bad interest rate is the only reason this real estate market is not on flames. We have such an inventory crisis, and the only thing that's keeping certain buyers on the side is interest rates. They will fall. When they fall, everyone will hop back in. And there will be people who say like, great, interest rates are low. Now I'm going to hop back in. But guess what happened to prices? They went up. And so the perfect time to buy is when other people don't want to, because then you can secure the right property and the right terms, and then you can refi later to get the perfect rate and an even higher cash flow position. So I say it with a sad voice, but like, it's still fine. So in this example, we're going to pretend it's still 7.25. It's probably not that right now. All right, this house needs new carpet in this example. So I put $5,000 in there. 30-year mortgage means my principal and interest payment is probably somewhere in this $2,200 range. This calculator isn't perfect, but our goal with the whole thing is to get close enough to be like, should I look into this further? Like, I don't know, let's say you're on Yelp and you're looking for a good restaurant and you like click on a few and you look at them real quick and you're like, all right, my top two are this. And then you come back and you look at their menu or the reviews or whatever the case is. Same kind of thing. We want some filtering criteria. That's what the spreadsheet does. All right. Next section is where you're going to plug in rent. If it's a single family house, you will only use one box, but you will use more boxes if there is more than one door to rent out. So we're going to use 2,500 in this example. And it's just the one door. So our gross rental on it would be 2,500. Vacancy rate means how often the property won't have anyone living in it. In this example, I used 5% of the year, meaning a tenant moves out and 21 days later, a new tenant moves in. I use that number because in my opinion, it's probably a pretty good average. Can you really flip a property, get it clean, get new carpet in, get it rented back out, get the tenant in 21 days? A little tight. But you're going to have tenants who stay for 2, 3, 4 years. And in those cases, your vacancy rate is 0. So I like 5% because I think it's a good average with what will likely happen over time. But that tells us that our net rent, so 2,500 minus 5%, is this 2,375. So we're just gathering data right now, and then we're digesting in a minute. Expenses. These are variable. So I'm going to teach the thought process behind each one. You can go with that. Property management fees. Sometimes I have people who say I'm going to self-manage. I think you're crazy, but good for you. I am not one of the people who likes to self-manage, so I got my gal Cassie who's renting out the properties. Cassie charges 10% as a property manager, like most property managers do. But for my people, she charges 8%. So you'll see that this cell is auto-formatted for 8%. Whether you're going to self-manage or hire someone, keep this number in here. Because there could be a point in time where you're 6 months into your new landlord relationship and you've had your 4th clogged toilet phone call where you're like, I'm out. I am not managing this property. And if you haven't financially accounted for it, that might not be an option. So I would say plan on it. And then if you're going to self-manage, then you know that you're going to make an extra $200 a month in this case. Leasing costs. It costs about $1,000 for a property manager to rent out the property for you. So I factored in $85 a month if we prorated it through the year. Maintenance reserve. I'm going to teach you the wrong way and then I'll tell you the right way. The wrong way is when I'm looking at a property, I make this say 0 because for me, that's almost like the cost of doing business. I'm going to have to replace a dishwasher every now and then. Hopefully not very often, I'm buying a new AC. Every so often I'm doing whatever, but I've already set aside the cash for that for all of my properties. It's just an account that sits there. That's what I need if I need it. So my maintenance reserve isn't something I factor in when I'm looking at my costs. I recommend that you do until you're comfortable enough or until that account is high enough where it's not a big deal anymore. So in this case, I just threw in $100. I think that's a solid number, $1,200 a year. Some years you're going to have expensive stuff and some years you're not going to have anything. Utilities. If you're doing multifamily, you're going to have stuff here. If you're not doing multifamily, you probably don't have anything here. A lot of multifamily doesn't have separate water meters or electric meters or stuff like that. So you as the landlord pay for all of it. And then you can either charge your tenants for it, which is what we do on our duplex, or it's just part of your cost. So either way, you're going to plug it in here as an expense. Property taxes, wherever you're getting your real estate information from, will have property taxes on there. So plug them in. Insurance, typical single family, $50 a month is not crazy town. I would use that as like a filler number until you find something that you're really ready to get into the weeds with and call your insurance guy about. But $50 a month is probably like a fairish place to start. This box is my least favorite box to ever put anything into forever and ever. Amen. This is your box that sucks the profit out of whatever house you're investing in. Examples include but are not limited to HOA fees. This line is why I don't usually suggest to people to buy condos or townhouses. If your HOA fee is $50 a month, it's not the end of the world. If your HOA fee is $300 a month, that's a lot of money. And the person who's getting the benefit is your tenant who's not paying more rent just because it's in an apartment complex. So I'm not a huge fan of condos and townhouses. The HOA fees would go here. Lawn care, I don't pay for any lawn maintenance for my tenants, but if you were going to, you would put it there. I should take this etc. out to say pool guy. Your 150 bucks a month that goes to your pool guy. Well, but you want to pay for it because if your tenant doesn't take care of the pool, then you've got, you know, a $5,000 new pump and a $10,000 new, like, nope. So you're going to pay for it. But in a perfect world, you get to leave this section blank because it just sucks the money out of it. So now we know our total expenses, how it gets broken down. We've got our mortgage payment. From there, from our gross income comes our mortgage payment and our expenses, which tells us our net cash flow if we purchase this house today would be a loss of almost $400 a month. You can see that here on the cash on cash return place. Cash on cash return means if you put $100,000 into buying a house and you made $10,000 a year, that's a 10% cash on cash return. What percent of your original investment are you getting back? If this house came on the market today, if my house came on the market today, I would not buy it. This is a terrible investment. But let's go back in time, shall we? Well, before I go back in time, are there any questions so far on this? There's probably a billion questions, but you don't know what they are yet if you haven't practiced this before, but are there any that come to mind? All right, so let's go back in time. So for the people who own your property that you're considering, like, does this one make sense to rent out? Let's do some new math. Fair market value when I purchased the property was $147. Sweet investment so far, right? I did not buy it at a discount, so I offered $147. I put 3.5% down. So $5,000 into the house so far. And my interest rate on it is one of my worst interest rates on a property, which is 3.75%. Wish I had more of those. Goodbye, old past with your fabulous interest rates. Over the entire course of owning the house, I've probably put $8,500 into it. So my mortgage payment, principal and interest is accurate here with $656-ish. We get, I think, $2,100 a month in rent. 5% vacancy. These costs are the same. My cash on cash return for this property is 70% a year. But it's been a rental for almost 10 years. So 70% a year for 10 years is not the worst investment ever. That is why this house is the stupidest house to ever sell. Now, you saw up above originally that it's really worth $425. So if I sold it today, the loan balance on it's like $100,000, I would make $325,000. Not so shabby. That's an awesome thing to sell. And if I had something super cool to invest in, I might consider it. But what would I invest it in? Real estate. And I would have a higher interest rate and I'd have less cash flow and the whole 9 yards. But this is where, when I get the question of should I rent or should I sell, this is the answer. What would you do with the $325,000? If you don't have a clear answer, that's okay. But then it just means you're going to put it in your checking account, which hopefully is high yield or something like that in this example, but still not a great investment compared to 70% annual cash on cash return. This is how you decide for your own property if it makes sense to rent it out or keep it. Are there any questions on how to analyze your own property? Very similar to the investment property option. All right. The reason I teach you this is it's the only thing you need to do to start. A lot of you said here and here that where do I start was the main question. This is it. I coach a lot of real estate agents who don't own investment properties, which is fine. There's no judgment there, but it is to say, why not? And for the most part, it's because they lack the clarity of being able to say, is this a good buy? So if real estate agents have a hard time with it, I don't expect anybody else on this call to understand how to do it because this is not your profession. But the good news is you can make this portion part of your financial tool belt where you're able to go through and analyze properties. So when you're working with an agent, what you would usually do is do version A of this on your own, right? Zillow says it's worth this, so I'm going to plug in that number. Zillow says the taxes are this, I'm going to plug in that number. And you get to the end, and after analyzing 5, 10, 15 properties, you'll start to see trends. Lost 5%, lost 3%, lost 2%, gained 2%. Well, that's weird. All the rest have been negative, but this one's positive. That's the one that you have your agent do a deep dive into. Hey, do you really think it's worth this? Hey, do you really think it would rent for this? Like, let me call my insurance guy. Would it really cost that much for insurance? And you break it down to be able to understand, like, this is what it looks like. Should I go see it? The last part in the investment conversation, ironically enough, is do I go see it? Because you wouldn't see anything that doesn't make financial sense. So you need to get clarity on this before you go down that path. Was I going somewhere with that other than to say that? No. All right, let's switch screens again. Got a friend on here who's an agent in a different state and said, us people in Arizona are very blessed to have the property taxes that we do. And amen, ain't that the truth? I don't know what it looks like in Florida, which obviously has their own fair share of all kinds of stuff going on out there. But my friend in Texas pays $25,000 a year. $25,000 in property taxes. Most of you on here are paying like $1,500 a year in property taxes. It's insane. Okay. Are you guys seeing the slideshow thingy again? Maybe. Nope. Great.
No.
Thank you. That's because I clicked on the wrong thing. All right, here we go. Now we're there. Beautiful. Okay, so step one is just analyzing a bunch of properties. So for anyone who gets to the point where they're like, I'm ready to start like learning more about this, this is when you would meet with your real estate agent to start talking about like, is this exactly like, let's start talking about a buy box and where do I want to be looking and stuff. So that way they can set you up on a search so you can start playing with this spreadsheet. So that's step one. Step two, right, is get our finances aligned. Step three is make sure you have a solid real estate dream team. Now, I have one person on here who's in a different state. So regardless of who you're working with, the agent you're working with, if they're an investor in real estate, has every single thing on here for you because they need it themselves. If not, you want to make sure you're working with someone or have access to everything you could need, right? When you buy a property, it's probably going to need paint. It's probably going to need carpet. It's probably going to need a handyman. So those type of contacts are when you're interviewing agents who you're going to want to make sure they have in their pocket. You're also going to need all the regular stuff you guys are familiar with. You're going to need a lender, you're going to need a title company, an inspector, stuff like that. But your real estate agent really should be able to help you with all of this stuff if investing is something you're interested in. So we know how to analyze properties. We know how we have clarity on our finances, and we've got our dream team assembled. Now we can start writing offers. So in here, there's three things to think about. Number one is we have to analyze those properties regularly. So much changes in the market with price and interest rate that there's a very deep effect on what that looks like. And if you're behind the ball and you go a couple of weeks without looking at properties, you might get back into it and think like, oh, I got a good property. Turns out it's kind of average now because interest rates went down and you're just not used to seeing the new cash flow position or whatever the case is. So we need to analyze regularly. Number two, we need to be very strict with our buy box as our filtering criteria. So if we have told ourselves we will not consider anything with less than a 2% cash on cash return, do not consider anything with less than a 2% cash on cash return. The good news about that is when you have that stringent, this is my number, it makes it really easy to write on a property when it's at 2%. Because you already turned down 25 properties because they weren't the right fit. And so when 2% comes up, you're like, I know this is a good idea because I have done so much research. This was my number. Now I'm ready to go. And then if that number works, write on it. If it doesn't, don't write on it. So we've written on it, we're under contract. Now we can set up all of our timelines for success. Real estate is a very predictable thing. It's just what happens after the process that gets a little bit less predictable with contractor timelines and whatnot. But usually when you go under contract, you have a close of escrow date. That means if we're closing on a house August 1st, August 2nd, I can probably have my painter there, right? The odds of something going wrong with that close of escrow date are much smaller than the annoyance that would exist by having to reschedule all your contractors. But during our escrow period, we can start lining all those people up. That way we don't close and then start finding people and find out we're now 2 months out from beginning work or whatever the case is. So when it's mapped out correctly, you can really line up construction with closing pretty tightly. Man, oh, I can't even drink my tea anymore. It's too late. I'll be up all night, just not looking at the clock. That is it. That's my verbal vomit of all of the things related to the very beginning of investing in real estate. Let me scroll through these, see if I missed any questions while you guys figure out if you have any. Oh, Travis, I just saw you want to rent your current house once you get the next one. You should do that. I love it. Interested primarily in income from rentals. Cool. All right. Then my question is, did I miss anything people were hoping to learn about today? 13 minutes ahead of schedule. I don't want to brag, but that also probably means I talk really fast and there might be questions. Then here's what I've got. Oh, Corey, you
Yes,
unmuted.
I've got one for you. Can you talk about what you use or what you would recommend others use when you're analyzing properties and trying to get an accurate idea of what it might rent for versus versus for property value? I feel like and it's just more accessible that like we find information on home value versus potential rent.
I've said this word once and I hate it. There's like a little real estate angel on my shoulder who's so mad at me for saying the things that I've been saying today, but I'm going to say it one more time. A great way to analyze properties when you're not 100% serious on one yet is Zillow. So this is what you're going to look at when you're here. Now, why do like the real estate gods hate me right now? Because Zillow can have terrible information. But we're not deciding to buy the house off of Zillow right now, right? We're just starting to analyze some data. And if you, let's say 20 homes fit your criteria, if every day a house popped up until 20 houses and you sent them to your real estate agent, like most of you are my clients, I don't have the capacity to analyze everybody's properties every day because most of them don't make sense for you, right? So taking a little bit of control over that will allow you to operate more in real time. And then we'll dig in when you're like, this one might be something, like, let's take a look at it. And I would say that also for every other real estate agent to ever exist because it's just not feasible. So in here, right, the data we're looking for is what's it worth? Well, look at, I overquoted you guys on my 425, but that's because I'm smarter than Zillow. But you'll see here the rent estimate is at 2,200. Now I told you guys it was on the market for 2,100, but let's look it up real quick because I have a property manager and I don't actually know these things. She does it for me. And then I forget all the things. What are we rented at right now? We are rented at 2,100. So in this example, this estimate is off. I don't believe I'm under rented. But it also is off on value. So those two numbers are likely working in tandem together. That would still gel well with your spreadsheet for an initial assumption. And then if you come down, I'm no Zillow expert, so let's see how well I can do with this. Yep, overview. If something's on the market, it's going to be even more detailed. Yeah, so it's not showing up. Oh, tax history. Yeah. So there you go, taxes. So we can get our idea on property taxes from here. So I overquoted our property taxes for our dialogue we were having. And so most of the data you'll need for that, you can find in this. So I would start there. And then, you know, when you find one that you're like, this might be a thing, then that's when you would ask someone to help you run more detailed numbers. Good question. Yay for a question. Are there any other questions?
So Kelly, I put it in the chat, but do you have a threshold for what amount of work or repairs you'd be willing to put into a potential rental, and they're using that as part of your basis on choosing?
That's a great question. For anyone who's already feeling overwhelmed, you can just like for a second, because this will be a complicated answer. That number depends on still what the very end number is going to produce for me. So like our most expensive one, I put 75,000 into it. And that was literally for nothing cosmetic. It was really weird to put so much money into a property that looked the exact same when it was done, but the foundation was jacked. In the living room, there was this big of a space between the wall and the ceiling. Not common. This thing was a mess. They had to go in and put it on hydraulics, and you Arizona people know that our foundations here are made out of rock, so it's quite complicated to do that. And it needed a new septic tank and a new roof and like all of this big expensive stuff. That deal was a deal. Even with putting all that money into it, the cash flow made a lot of sense. And for anyone who wants to do the BRRRR method, buy, renovate, rent, and then refinance, we were able to pull all the cash out that we had put into it. So at the end of the day, it's still at a positive cash flow and I have $0 into the property. So I think it just takes time to like really analyze, like, is there a way that this does make sense? Because sometimes it's just not readily obvious. But in that case, it worked out. So for me, it's just always, if the numbers make sense, I'll go as high as I need to, if it's still a good deal. That's a good question. Jessica, I love your question. How do you go about finding and using the right property manager? I think the easiest thing to do is to get a recommendation. We have a property manager we work very closely with. She manages all of our properties, but we have 2 backups that we also give to clients, because I get that like not everybody loves everybody. Here's the general things I would look for. In the world of both real estate agents and property managers, there's full service and then there's discount. Theoretically, they both have merits. I personally don't see the merits in both, but I will explain it. On the discount side of things with property managers, you can find, you guys have probably heard the commercials for Renters Warehouse, especially if you listen to like 104.7. Renters Warehouse is essentially like the Walmart of property management, right? You're there for the deal. You are not there for the service or the product. It is literally a need a thing and you have a good price for it. Versus a full service property manager being more like Target. Still need the product, but you want the better service and you're willing to pay a little bit more to make sure it is made of higher quality and at a higher price. Also, I just realized the Target thing is a political thing. So I'm not trying to make this a political thing. It's just a Walmart versus Target for prices. So on that side of things, that's the difference. So Renters Warehouse is probably up to like $75 a property. So if you think of our example property, we're paying $200 a month, and that was at a discount for a full service agent. So the cost difference is big. The result on a rental property is not something I'd screw around with, right? If you're having someone manage theoretically your largest financial asset, that wouldn't be the one I'd cut corners on. Examples would be like, what if the tenant trashes your property and then leaves in the middle of the night? Or if you don't know, I had a tenant burn down a house this year. That sucked. But I have a good property manager, so it was very nice to have her support through that time. House is still being rebuilt. The whole thing will be better in the end, but not an ideal setup. So right, things can go horrifically wrong. And those are the times that people are like, oh, I shouldn't have managed this myself. Versus 98% of the time, the annoyances are going to be like, then my toilet's clogged conversations. And so for anyone who wants a passive investment in general, I would say like ask about their services and what they provide. I think online reviews can be kind of hit or miss, because most of the time the people leaving online reviews are tenants who are pissed off about whatever. They're not usually homeowners who are using the property manager for what you want to use them for. So online reviews isn't going to be great. I'd probably ask for real life examples of people. and you know what they like about them. I always say Cassie's my velvet hammer. She makes tenants feel really good and very wanted in our houses, which because of my background is incredibly important to me. I'm not here to be a slumlord. I want them to feel like this is something I care about, and them being part of that is something important to me. That is true. It's also true that this is an investment for me. And so the numbers always need to be making progress in the right direction and to be fair with the market. And so when I call Cassie and I'm like, hey, when are we going to get to do rent increases? And she reminds me at the end of the lease and to calm down and stop calling her because she's doing my job for me and I should stop being worried about it. And she will do a property analysis when it's time for the tenant turnover and come to them with, hey, we need to increase the rent from $2,000 to $2,100. And I already talked to the owner. We want to fill in the blank with whatever the house needs to make it worth it for the tenant to get that increase. It's a win for them because they feel like they're getting something out of it. It's a win for me because I'm getting more money out of it. And so both parties are very pleased. So she does a good job of protecting my money, but also representing the property.
Thank you.
Thank you. You guys have more questions than last week's people. Great job. Also, when I send this recording to last week's people, they're going to hear it. You guys didn't have as good of questions, so I'm just going to say it. Anything else?
Hi, I have a question.
Yeah.
So we currently are in our first home that we plan on renting in about 2 years or 2 years or less, I should say. We're going to rent it out and buy a new house. The thing is that we have solar. What are your thoughts with solar and tenants? Obviously, they're not going to be paying like power. So is that something that like we should just be like, hey, here's a flat rate for water, power, sewer, trash? Like, or how should we incorporate that in for the renters basically? So it's fair. They're not like, hey, we're being screwed here. So.
Yep, that's an awesome question. My house that burned down had solar on it, so I can tell you single-handedly what we did on that. We charged more in rent to offset the benefit. Not offset the benefit. How we pitched it was rent includes property, XY, like everything that came with it, and solar panels making your electricity bills Y. Like I forget exactly how it was phrased out, but it was to help people understand instead of a $300 July payment, you're gonna have $50. That's how we did it. You could theoretically do it in any way you and your property manager think makes sense. Like you could charge them whatever payment you're paying for the solar as like something outside of the lease. That is a way you could do it. There's probably other ways. You could probably offer to pay all of the electricity for them, like to keep it in your name, and then just charge like a substantial amount more. So that way it's like rent is $2,000 a month and a $300 charge flat fee for utilities. Then for some parts of the year, you're going to be getting credits. And for the other parts of the year, it's going to be $0. For anyone on here who doesn't have solar, who is considering solar specifically for a rental, I don't recommend it. Similar to Aubrey's question and my situation with the solar, it's just more complicated and you're probably not going to get enough of a benefit to be like, I'm so glad I put solar on and got to experience the benefit of it for 2 years or whatever the case is. So I probably wouldn't totally recommend it. But solar has tax benefits and all kinds of other stuff. So I'm being very exclusive to the conversation of like, should I put it on my property? But there's much more that you could look into just beyond like, what will I get in rent? Which is still a good question. That's not to say it's not, Aubrey, but just to say if someone was thinking like, should I put it on? There's more than just, what am I going to get for rent in this case? Good question. All right, it's 6:30, I think. Yeah, and I want to be very respectful of everyone's time. I'm so glad you guys came. This is fun. I could obviously talk about it all day. I'm sure you've heard my weirdo passion for it. I'm grateful you're here. For my friends who are out of state who need an agent to invest either where you're at or where you want to be, then let me know. We've got people like Brianne who's on the call all over the country. And of course, if you guys ever need help investing here, I'm happy to help answer any questions, but I appreciate you guys coming today and enjoy the rest of your Tuesday.
Thank you, Kelly.
You're welcome, guys. Thanks for coming.
Bye. Thank you.
Bye.